Wall Street, the stocks ended higher for the fourth day, and the stocks gained despite the weak Q1 GDP data that came in. Remember, it slowed to 2.2% with expectations of 2.5%. So while for the week, the best weekly gains in a month posted by the US markets, they ended decently okay, despite the fact that the data was not too positive. Amazon and Expedia, the Q1 beat expectations. Expedia surged 23.5% to $40 odd. Amazon up 15% to 226 odd. Remember, the retail index, S&P retail index, is up 3.5%, trading at an all-time high. You wouldn't be surprised with the kind of crowds that you see at some of the retailers in the US. Probably a depiction of what's really happening in that space. But to talk about the US markets and the cues thereof and what are the markets likely to do going ahead, Christopher Vail, CEO and CIO of Asia AT Rexiter, joins us right now. Good to have you, Chris. Thanks so much for joining in. The US housing data was good. The offset jobs data, I mean, could the US post stronger than expected recovery in light of all that's happened in terms of data coming out, the GDP coming out yesterday?
I think while there are concerns about the Eurozone and various other sort of macro concerns, even the Middle East and other issues, yes, I think probably so. I mean, they've bounced from the troughs in the fourth quarter of 2011, and all markets have had a rise, in particular emerging, but also developed. But I think we've reached levels where, although the valuations we think are fair to cheap, we think the catalysts need to, not need to, but it really needs a stabilisation of the Eurozone. We've had this sort of risk-on, risk-off environment for some time now, going back to 2008, and that improved at the beginning of the year, but at the moment it doesn't look that way. So I think in the shorter term, range-bound, but longer term, we think there'll be stability, and therefore they'll rise with earnings growth.
Christopher, what about your reaction to the Q1 GDP data coming out in the US? Because that's been below what the street was expecting at 2.5% growth.
Yes, I think everything follows on one from another, really. When risk is off and markets generally are bad, and to keep it simple, for example, when Eurozone concerns were at their peak, etc., we think developed would outperform emerging. But once you get stability, we think the correlations with markets comes off, stock pickers come to the fore, and emerging will outperform developed. So in the shorter term, we think they'll both be range-bound, but longer term, as markets rise, we think emerging will outperform developed.
Okay, and that's the point that I want to carry forward, Chris. Contrary to what happened in 2011, do you think that this year could belong to the emerging markets vis-à-vis the developed markets?
Well, we run different strategies, really, so if I can slightly answer it a different way, I mean, we run an equity strategy and we run a local currency debt strategy. They're two separate strategies, so we're not buying bonds in the equity portfolios and vice versa. So maybe I could give some indication of what we're doing with each. In the emerging equity space, we still think, as we said, markets are reasonable value, so we'd be sort of neutral to slightly positive overall with certain favoured markets, such as Russia and China. Perhaps slightly less keen on India in the shorter term because we think they would probably more suffer if things went wrong with the Eurozone. In emerging currencies, generally the same, but underweights in the European area to a greater extent. And then there are some specific country bets where, for example, we were very overweight in Indonesia, but we've come out of Indonesia and we went into the Philippines and Thailand instead, as an example.